Okay, thanks everyone. We'll just start right now. We got couple of items today. Just an update on our second quarter strategy report. Then Natalie will just go through the recent initiation of Ascott Residence Trust. Then we got our US weekly update, and then we have our China weekly update. Okay, just to recap on our second quarter strategy report. Before we proceed, just to have a quick review of what happened in the first quarter. In the first quarter, the two sectors that did really well were the REITs. As you can see, most of them had a double-digit, at least low double-digit kind of returns. And the other part of the STI that did really well were some of the cyclicals like venture and even Yang. What did not do well in the first quarter were the banks. And also some of the conglomerates, especially the Jardine boys, these are the ones that got the most affected, that dragged down the STI. Okay, and we'll just move on. What we think are the themes. We are still positive on the market. I think first quarter the market rallied because, as we mentioned before, the two policy risks that faded was higher interest rates and also the trade wars. So as we move on to the second quarter, some of the themes that why we think the equity market will still be positive is firstly, the STI is cheap. As you can see, the valuations are at the 170 deviation lows. The other part is that in terms of interest rates, there's no real global benchmark, but if we use this as a proxy, this is a accumulation of all the interest rates of all the key markets like US, Japan, and Europe, even Canada, Australia. So it just shows that the interest rates are now back to 2-year lows. So this low interest rate backdrop obviously is positive for equity markets. The other part is, of course, the stimulus from China. Of course, we all know the fiscal stimulus in terms of VAT rate cuts and also income tax rate cuts, and also a slight increase in the deficit spending. But also you can see that liquidity has been injected. This rolling 12 months in terms of the net amount of loans that's being disbursed into the economy, in a way you can say. So as you can see, although we had loans growth, but the amount that's actually injected into the economy didn't really change much since middle of 2017 to mid-2018. But since mid-2018, as you can see, as we know, the authorities has always been mindful about increasing the leverage in China. But from middle 2018 onwards, especially in the fourth quarter, they started to inject more liquidity into the economy, at least in terms of loan disbursement, as you can see from this part. The fourth point, of course, the fourth theme will be we think that there will be some resolution on trade. It's very hard to get any particular chart on this, but just looking at how on all Trump's Twitters on China trade, as you can see from last year, from the second quarter, when all this started to happen in April, at least in the first half of 2018 to the third quarter of 2018, as you can see, all his comments on China were very negative, from unfair to US being taken advantage, again to China manipulating. But since November, I guess maybe in part, I guess from the weak equity markets, you can see that he's changed his stance on China. They've got good conversations, very productive with China, and the trade is progressing very well, and the deal is moving along nicely. So all this just point to some, at least some conclusion between US and China in terms of the trade. And the final part is just on our, as you know, we have a model portfolio. So these are some of the changes we've done from April onwards. Obviously, the return that you see 7.1 is with the old names. We didn't want to include the old names that we removed. We took out Ascendus REIT, Capital Commercial Trust, mainly because they met our target prices. We took out Geo because I think the results have been disappointing. So in what we replaced in is Ascott REIT, which Natalie will elaborate later. We also added in Netlink NBN Trust, mainly because of just to provide some stability in terms of yield for our portfolio. As you know, our portfolio, we try to kind of balance it out with yield, dividend growth, and also some re-rating plays. So and then we removed Geo, and then we added Singtel. For Singtel, we think that there should be some re-rating on Singtel as the associates are getting better. What we see is that the ARPUs out of India and especially Indonesia is improving, or at least for India is stabilizing. And even in Australia, they're raising their selling prices. And we think for TPG, the fact that they're delaying their launch into the end of this year shows that, they've got probably some competitive issues in terms of releasing competitive prices. And the longer they wait, the more scale you're going to get from the MVNOs. So that's it. So these are all our picks for the April onwards. Okay, I'll move on to Natalie. Thanks.
Hi, good morning. So today I'll talk about our initiation on Ascott Residence Trust. We've initiated coverage with a buy and a target price of $1.36. Okay, so a bit about Ascott Residence Trust, or ART. They are the owner operator of service residences with a market cap of 2.5 billion. Their income is sourced from 8 key markets. As you can see, US, Japan, UK, France, Vietnam, etc. So for their EBIT, right, about 75% is actually derived from developed markets versus emerging markets. Their sponsor, Ascott Limited, is the hospitality arm of CapitaLand. CapitaLand has a market cap of 15.3 billion. Our table below actually shows the number of keys that Ascott Limited has and ART has, just to illustrate the scale of the respective companies. So we have three key investment theses. The first one being income stability through geographic diversification and lease structure. These are the two pillars of stability that we view are attractive. First of all, it's the revenue models. So they have 3 revenue models: master lease, MCMGI, which stands for management contract with minimum guaranteed income. Basically, the minimum guaranteed income is like a floor or a minimum rent that has been guaranteed. Currently for ART, all of their assets under MCMGI are generating more revenue than the minimum guaranteed income. So these 2 segments, the master lease and the MCMGI, are viewed as the more stable sources. As you can see from here, it accounts for about 40% of the revenue. These are like fixed and like guaranteed. The remaining 60% is more of a variable, and it's more driven by RevPAR. For our second pillar is actually the diversification of ART's revenue. As you can see from this pie chart, no one geography contributes more than 15% of gross profit. We view this diversification to be desirable. Our second investment thesis is actually the 800 million debt headroom due to their gearing of 36.7%. And also they have 20 ROFO assets available to them from their sponsor. As you can see from this table, this chart, the number of keys the growth in the number of their sponsors' keys has been increasing at a 36% CAGR, and with their signing of 26 management contracts, predominantly in China at the start of this year, they have actually hit their target of 100,000 keys prematurely. The management has said, the sponsor has also said that they will continue to grow the number of keys, and they target 160,000 keys by 2023, which is in about 5 years. So because ART's assets are mostly managed under Ascott, the 3 brands are Citadines, Somerset, and Ascott. So by the sponsors growing their keys, it also benefits ART in the sense that there is more brand awareness and traction. The debt headroom, the illustration on the left, it illustrates the debt headroom and the potential for DPU uplift if ART were to use up their debt headroom. So with a debt headroom of 880 million and an interest rate of 2.3%, their low interest rate is due to them having an investment grade credit rating. And we're using a hypothetical yield of 6%. you can see that MPI or gross profit will increase by 52.8 million. After transaction costs and finance costs, it will lead to a 22 million increase in distributable income, which is a 1 cent increase in DPU. So for the first year, after accounting for transaction costs, the DPU can stand to increase by about 6.9 or 7%. Without accounting for transaction costs, DPU will increase by 7.5%. Our last investment thesis is that less capex and opex intensive requirements for service residents. This is due to bulk of their stays being longer stays, targeted at the corporate segment, where longer stays are between 3 months to 2 years. So there's less wear and tear from the turnover as compared to hotels, and this will lead to less maintenance capex required. Additionally, because service residences are only offer selected or rather limited services by intention, this actually they're not full service like hotels. So this will lead to less OPEX needs in terms of manpower. Okay. We'll move on to Edmund for US Weekly.
Thank you, Natalie. So right now I'll cover the US Weekly. So for the macro last week, the headline CPI rose to 1.9% in March. Core CPI inflation declined to a 30-month low of 2% from 2.1% before. So this is a sign that the low inflation expectations were exerting downward pressure on inflation. And since inflation and unemployment are relatively constant, it is unlikely for the Fed to raise interest rates in 2018. As for the University of Michigan's consumer sentiments, it declined in April from 98.4 to 96.9, which is driven by the fall in forward-looking expectations index. And this is consistent with the Small Business Optimism Index, which, although it edged higher in March, but it showed a deterioration in confidence over the past 6 months. The small firms also have lowered their demand for labor, and February survey showed that the jobs opening rate has dropped to an 11-month low. So for the week ahead, some of the key indicators to be released will be the industrial production, balance of trade, and the retail sales. So these are a list of the upcoming earnings release. So for today, we will have Charles Schwab, Citigroup, and Goldman Sachs. So right now I'll cover a bit about the US banking sector. So for the past 3 weeks, there's a lot of talk about the yield curve inversion and how the banks will be adversely affected. So I'll just give an update. We see that the commercial and industrial loans is still going strong. In February, it rose 10.1% year on year. As for the consumer loans, it is relatively constant the growth is relatively constant for the past 6 months at about 5%, while mortgage loans is slightly lower at about 1.2%. But we believe that the mortgage loans is likely to improve because of a lower mortgage loans rate. We also see that there is a healthy asset quality. From the bottom left-hand chart, you can see that the banks are tightening their lending policies. And from the top left chart, you can see that the NPL to total loans ratio is currently at record low levels. And the same goes for the charge-off rates. As the consumers get accustomed to the high interest rates, so deposit rates has been increasing at a faster pace. The 3-month certificate of deposits and the 6-month CD have increased 43% and 48% year on year, whereas the prime lending rate has only increased 16%. So we believe that the net interest margin is likely to expand more modestly in 2019 as deposit rates. But however, as deposit rates started at a very low base, which is less than 1%, although it is increasing at a faster pace than the prime lending rate, we believe that it will take some time to catch up with the lending rates before you will have a modest impact on a more larger impact on the NIM. The efficiency ratio or the cost to income ratio is actually at low levels. And we see attractive valuations for the banking sector because currently, sorry, the banking sector's valuations is at historical low levels. It currently has the lowest PE and PB ratio, despite the fact that it has a respectable EPS growth for 2018. That's why we maintain our overweight on the banking sector. We believe that the investors' concerns about the accommodative Fed and the yield curve inversion is largely overstated. And we still see growth for the US banks, especially because of its attractive valuation, healthy asset quality, and stellar loan growth. So these are the ETFs that track the banking sector. So with that, I'll pass on my time to Jie Yuan.
Thanks, Edmund. For China last week, the fiscal policies headlines will be the China released announcement on the key task for the new type of the urbanizations constructions. Mainly, it removed the restrictions of the cities have a residence of the 1 to 3 million peoples. As we observed, there is a 59 city will be involved. On the first way, China will remove the restrictions of the residencies for the 3 to 5 million residency cities. It will involve the 10 cities. Coming to 2019, we are seeing a lot of the positive fiscal policies coming along, including the PBOC's cut the RRR rate, Great Bay Area's developments, cut the add value tax, and list household restrictions. As we observed, there is the frequencies is more frequent, and we are thinking the positive fiscal policies are boosting the market confidence. For the economic indicators, we are seeing the new yuan loans and the money supplies both beat expectations. We are thinking they will further boost the confidence of the market. For the stock recommendations, our Hong Kong research teams recommend China Soft Internationals based on because of the influence of the Huawei incident on the China Soft Internationals. The price of the China Soft Internationals are going down. We are thinking if the Huawei instance can be solved, the price will going up. Our Hong Kong research team give the target price of the China Soft Internationals Hong Kong dollar 6.57. On this week, we are waiting for the China's March industrial productions and retail sales. Also, the China's first quarters of the GDP growth. This is a list of our Hong Kong research team's stock recommendations. That's all for today's webinars. If there are any questions, please leave on the chat board.
The outlook for the next quarter for the banking sector in Singapore, since US banking sector is good. So for the upcoming results in May for the 3 banks, UOB, OCBC and DBS, the results should be supported by the net interest margin expansion for now because of the lagged effect of the interest rate pass-through. So we all know that the Fed has already paused interest rate hikes and the series of them even lowering interest rates in the future. So for the upcoming first quarter 19, net interest margin might still improve a little bit more, but for the next 6 months or maybe for the rest of the year, we might expect net interest margin to be rather stagnant or flat for the Singapore banks. And then the other thing is their loans growth. For Singapore, our loans growth it is being dragged down by the mortgage segment. So that's the difference between Singapore and US. US mortgage segment is still growing pretty well, but for Singapore, our mortgage is actually contracting. So for the Singapore banks, with the majority proportion of the loans being centered on mortgage loan in Singapore, this might be a headwind for the Singapore banks. So this is mainly due to the property cooling measures last year. And for some of the banks, they have the upcoming repricing coming for the mortgage loans, so that might lessen the pressure on the interest margins for the loans growth. So as for asset quality wise for Singapore, it's similar to the US. US asset quality is benign. In Singapore, there's no reason to doubt asset quality at this moment. And the banks have already been very conservative in providing for provisions for the oil and gas sector. So majority of the provisions are probably already 70 to 80% provided for in the past few quarters. So any problematic loans or provisions might be from unexpected one-off clients for the banks. Yep, so the upcoming results for the banks will be UOB first in the first week of May. Yep, so keep a lookout for the announcements. Thank you.
There's a question on the outlook for REIT in the mid to long term, and the REIT prices have gone up high recently. Whether it's still possible to buy. So our outlook for REITs has been unchanged for the past few quarters. We're neutral based on the macro outlook because the yield spread is still very low. It's below the, in fact, recently it's even dipped further below the -1 SD line post the global financial crisis. So the yield spread is not looking great, but and even with the run up in prices recently, most of REITs have actually reached the saturation point in terms of valuation, but there are still some key picks. At the back of our REIT monthly report, we do outline the calls for all the REITs under our coverage. Some of them are Ascenders, CCT, and Capital DC. So there are still some favorable picks within the REIT universe, and especially and if you're looking for the subsector top down, we recommend looking at the commercial and hospitality because these two subsectors still have very favorable demand supply dynamics. Thanks.
Hi, there's a question on Yang Zijiang. We don't cover it, sorry. If there's no further question, we'll end the webinar. Thank you.